Hi, everyone. Welcome to the Canadian Passive Investing Show. I'm your host, 𝗖𝗍𝗶 Benesocky, and I'm joined by my co-host, August Biniaz. We have another great show for you today. Please like and subscribe as it helps us build our channel and allows us to keep bringing you great content and amazing expert guest speakers. Our mission is to empower investors to earn passive income through real estate investing. Now, today we're joined by Omar Khan. Omar was a CFA with 10 years of investing Omar Khan was a CFA with 10 years of investing across real estate and commodities. He advised on $3.7 billion, and that's with a B, of capital financing and mergers and acquisitions transactions. Omar syndicated large multi-million-dollar deals across the US. He also advised high net worth advisors and entrepreneurs on real estate portfolio allocations. And he is a global citizen. He lived in Dubai, Toronto, Calgary, and Dallas. So we're really excited to have him today. And we believe that the interview with Omar will be helpful to international investors looking to invest in US multifamily. But also this interview will be helpful to high net worth individuals looking to lower their taxes by investing in multifamily assets. So welcome, Omar.
Welcome, Omar.
Thank you. I really appreciate being here after I rescheduled a few times. So I'm very appreciative that you accepted me this time and had me on your show.
No, it's definitely an honor. We see you in the kind of the multifamily circuit in this space, and you're definitely a thought leader. We're excited to have you on and dive into your mind and learn lots from you and add a lot of value to our viewers. So excited about this. Yeah,
definitely. And Omar, you're based in the US, of course, but you're originally from Canada. And our team here at CPI, we're Canadians, but we invest in the US multifamily. So we're really looking forward to this interview and to have a great chat with you. But before we start, we really wanted to start off by you telling us about your background in finance before we talk about, your start in real estate and in multifamily.
Look, my background in finance was I graduated from University of Toronto, worst possible time, 2008. So that kind of sucked, bad timing there. I worked in Royal Bank of Canada. If your audience is Canadian, they'll probably know RBC. I worked in RBC, where else did I work? McKinsey, RBC, worked at CIBC as well. I worked in oil and gas. So I kind of did the whole investment banking buy side and sell side route. While there, we did a lot of deals, kind of learned how to structure deals, both debt and equity. And again, the big reason for that is my family's fairly financially sophisticated. So I kind of had that exposure growing up. Enough people were in some shape or form related or in the industry or had exposure. So a lot of these things were, it's like if your parents are doctors, right? Chances are you just know more about doctors and what their life is and all of that kind of stuff, right? That's kind of how I did it. In between, I did the CFA as well. That was primarily because, frankly, it's a prestigious thing, and pretty much everybody else I knew was doing it. So it wasn't like I put a lot of thought into it. It was like, all right, it's doing it. It's very hard to do it, which I obviously found out much later, but I was too deep into it to quit. So I did that, and that's really helped me improve, not just technically, but otherwise personally as well. Moved out of the US about 5.5, 6 years ago, maybe a little bit like that, right? And the reason for that was I was getting married at the time. So my fiance, now my wife, she was right about done with her residency, and it was a toss-up between, should she move up to Canada? Do I move down to the US? And just the way the Canadian system is versus the American system, and just generally, she'd have to do everything again. So she'd have to do all her residency again, training again, even though she'd done that already. So I was like, oh, that's kind of stupid. I'm not going to subject you to that kind of torture. So I just moved out of the US. I consulted with a healthcare firm. The reason why I started in real estate was my family's been in real estate for 2 generations. So I'm the 3rd generation. So we bought everything multifamily. Well, not really that much multifamily. Lots of hotels, lots of shopping centers, retail, triple net plays, all of that sort of stuff. And we'd held on to that as a family portfolio across multiple generations, had a lot of exposure there. But the big reason impetuous for me was that I just wanted to reduce our taxes, and I wasn't going to go, I wasn't smart enough to go build the next Facebook or something like that. So real estate was the stupidest, dumbest way of me reducing my taxes today, right now, right? Without necessarily being, creating like some world-beating new idea that nobody had ever thought of. So, did that. I had a buddy of mine from Toronto. They run a small family office. They were looking at a couple of deals in Houston. That was part of their estate planning thing. I helped them structure a couple of those deals, and, just did one deal, put my foot did another deal, did a couple of developments, doing acquisitions and developments. I own a few businesses as well, which I'm a shareholder in. I've got other partners in those businesses. So it's, when you start going down one path of entrepreneurship, right? Multiple opportunities open up, right? I mean, you guys are starting out, so you will see also like you do one deal, you'll do two, you'll do five, and hopefully over the long term, you'll do hundreds of deals, right? So, when you start going down one path, opportunities start opening up. And again, in the US, I feel it's a lot easier to be an entrepreneur than in Canada. Even though I love Canada, this is not a slight against Canada. In the US, it's much easier to be an entrepreneur. So that also helps, right? The general people here are just more entrepreneurial. So when you're in a very supportive type environment where most of the population is entrepreneurial, that also helps, right? Because we're a product of our environment. Totally. Right? So when you have a really great environment for a certain task, it's more easy to do that task, right?
Yeah, absolutely. And we plan on moving to the US one day, so we'll feel that same kind of vibe that you've been through. So
well, we already feel it. I mean, I've been in business here for 15 years in Canada, but when we started looking at the US for the multifamily value-add business model, and we started kind of making connections in the US and talking to different operators and sponsors and investors, we realized, that just like you mentioned, the mindset is totally different. People are very entrepreneurial. They're very open to doing business. It's they're not very guarded. They're very open, and they're very open about the business they're involved in. Canadians are much more conservative. It is a much more difficult process. They always say, if you make it in New York, you make it anywhere. In my opinion, if you make it in Canada, you make it anywhere, because
oh yeah. If you made it in Canada, you can literally make it anywhere in the world, because the odds are stacked against you, basically.
Yes. And the taxes, you got the immigration policy that literally cherry picks the best from around the world and brings them here. If it's skilled workers, if it's entrepreneurs, if it's investors, the system is built to get the best of the world here. So you got engineers who drive cabs. So imagine that, right? Imagine a country that people coming from other places in the world are very highly educated, and now you're competing with them. So I'm a true believer of that here. But maybe we can.
Yeah, but it sucks when you're in that system and you're on the receiving end of competing against so many intelligent people.
Yeah, true. Very true. Omar, I wanted to touch base and kind of talk to us about your start in real estate, and then particularly multifamily. And what was it about the sector that interested you, other than, which I hope that you share with us, the tax benefits for?
Oh no, honestly, it was just the tax benefits, really.
Yeah, I was going to say.
We just had a big tax bill, and we wanted to get rid of that tax bill like pretty quickly. And frankly, I was just seeing more compelling, at that time at least, more compelling valuations in multifamily versus other sectors, right? Yeah. And I wish I had more money, and I wish I'd bought a lot more then. I'd be a lot richer now. But it was frankly a tax bill. We just had a tax problem. And luckily for me, I had both a professional background in running and structuring deals, so that kind of helped, right? But I also had a personal background in, my family's entrepreneurial. They've been involved in the real estate business amongst other businesses. So, I had some background knowledge going into this, right? Because if I didn't have a lot of background knowledge, then frankly, this climb would be much steeper, right? And it would be harder for me to do it. But the big reason was a tax bill, because luckily for me, my wife is a high income earner as well. So it was a tax bill, and necessity is the mother of invention. We had a tax bill, had to look around for options. We proactively chose a vertical where we thought we could get more compelling valuations, more high ROI for our money. And coincidentally, at the same time, the buddy that I was telling you that runs a family office out of Toronto, they were doing some estate planning stuff. They wanted to sell their retail and office stuff in Houston, move into multifamily. So it was kind of a confluence of events at the same time. But the big reason was tax bills. I just did not want to pay my taxes, or I wanted to rather reduce my tax liability as much as possible.
Of course. And why don't we just quickly talk about the top couple tax benefits that are included in.
Yeah, I mean, there's only one tax benefit, if you ask me. That's just the cost seg benefit. You can take accelerated depreciation, which, I mean, there's others like 1031 and all, right? But as a Canadian, you cannot enjoy 1031, no matter what somebody tells you. You're not going to be able. You can 1031. You still owe the taxes to CRA. So the whole point of doing a 1031 as a Canadian does not apply to a Canadian investor living in Canada. Now, if you're a US resident, but happen to be a Canadian citizen living in the US, oh yeah, you can 1031 all you like. So really the big advantage tax-wise, to me at least, is cost segregation or accelerated depreciation, if there's any accountants on the show. It's just a fancy way of saying accelerated depreciation, which you're not able to do in that frequency and that intensity in Canada, and frankly, most other places that I know of. So just, you can take a lot of these write-offs up front in the first year, 2 years, 3 years, and then you can write it off against your income. So that helps. But in my particular case, because I was also a real estate professional, which is a tax classification, so I was able to take all of the write-offs that I got from multifamily and write it off against my wife's income as well, right? Because if you're not a real estate professional, you get all these write-offs, right? You could have $1 million in write-offs. But if you only had, say, $1,000 in real estate income, you can only offset 1,000 against 1,000, right? Maybe you had $10 million of income from, I don't know, you're a doctor or a business owner or something, right? Well, you can't offset the 10 million in write-offs we have here with 10 million in total income. That's from non-real estate sources. But if you're a real estate professional, you could have, say, $10 million in real estate write-offs. And let's assume your wife or your partner has $10 million income that year in a completely unrelated business to real estate, could be whatever, right? And you could just write those things off. So net, you could have a $0 tax liability. Right. So that's basically the big thing for us. Because again, my wife's a high income earner. Thank God. So we are able to basically use her income and basically manage our tax position there as well, on top of whatever money I make.
Super powerful stuff.
Great.
Wow.
And now how does someone get that designation of being a real estate professional?
Oh, in the US, it's look, I'm going to obviously butcher it. You should go to the IRS website and see it, but there's an hours requirement. You have to spend a couple of hours. It's not that much. It's like 760 or something, but don't quote me on that, hours. And you have to document what you're doing. The whole point is, look, you are primarily in some shape or form involved in the business of real estate. You could be a property manager. You could be somebody who buys real estate. You could be a developer, right? Whatever. You're primarily involved in the affairs of real estate. That's kind of your industry. So if you spend the bulk of your time, and again, there's certain rules, but they're not very onerous, to be very honest with you. If you fit in those rules, which are not that hard to begin with, if you're actually in real estate, you just qualify. You just have to check the box and you qualify as a real estate professional.
Okay.
But if you don't, then you can get all these write-offs, but you can't offset them against non-real estate income.
Nice.
Thanks for sharing. It's nice. You can keep carrying them forward, but I mean, it's no use in that year.
Just one quick thing. So as far as the 1031, you're definitely right as far as Canadians looking to invest in the US, because the goal is to repatriating the profits you've made in the US to back in Canada. So, you can use it for. Yeah,
but for instance, if you didn't want to repatriate, right? This is my understanding at least, that if you just had, say, a great tax capital gains on one property, you're like, hey, I'll just 1031 into a new property in the US as a Canadian citizen living in Canada. Now, if you're a Canadian citizen, but you are a US resident, so you spend more than half the year here, you have to pay taxes in the US primarily, not in Canada, right? But if you're a Canadian citizen living in Canada, you cannot 1031. I've had this question asked so many times. Lots of people say, well, I read it on the internet. And the point is, most of the stuff you see on the internet obviously is written from an American point of view about 1031s, because it's an American thing. So the Canadian, you cannot do that.
You cannot roll your money over into the next.
So the IRS will.
No, you can roll. No, hold on. You can roll whatever you like. Whatever tax liability you owed that year, the IRS might not take it from you, but the CRA will take it from you, because the CRA considers it's called a deemed disposition. So in the eyes of the CRA, it's a bit like you just sold the property and you took the profits.
So
they don't care.
Even if you don't let's say Ava and I bought a property in the US, we sold it after a year, but we bought another property and we complied by all the regulation when it comes to.
You're compliant in the US. You're not compliant in Canada. So 1031 does not exist in Canada.
So the CRA will say, hey, you guys bought a property, sold it, but the profits haven't come to us yet.
That's not their problem. That's your problem. You chose to not take the profits. You chose to roll those profits into a newer deal. So from the context of the IRS, as an example, you're okay, because they know that 1031 is a thing in their tax code. But again, this applies that if you continue living in Canada, right? Say you guys live in Vancouver or somewhere, right?
That's right.
Right. So if you continue living in Vancouver, you continue being Canadian citizens living in Canada for the vast majority of the year. So you have to pay your taxes in Canada. 1031 does not apply to you. In fact, you might end up paying more taxes, because not only will you pay the initial capital gains tax to the CRA, you won't get an offsetting tax credit from the IRS. So number one, you paid that tax without a credit. And now the next time around, the second, third property, whichever one you've gone into, when you sell that property, now you'll pay a capital gains again without a tax credit. Because if you had just paid the capital gains in the US, at least you get a tax credit from the IRS because Canada and the US have a treaty. So they say, hey, if you paid whatever, say if your tax liability in the US was 10,000, but your tax liability in Canada is 12,000, and if you paid $10,000 taxes in the US, the IRS will give you a credit. So you only really have to pay $2,000 in Canada. Yeah. Right. But if the IRS never gave you a credit because you never paid your taxes and you 1031, well, you've got to pay all that $12,000 here. So again, I know it's kind of confusing the first time you think about it. Just in a simply put, just realize if you're a Canadian citizen living in Canada, filing Canadian taxes, you cannot 1031 no matter what some article on the internet tells
No,
you.
what if you buy it through a corporation in the US and that?
Bro, it doesn't matter, man. It doesn't matter. These people are not stupid. This is not their first rodeo. Trust me. They have done all combinations of these things. They have either experienced, seen, or encountered before. Doesn't matter. You can call it the ABCD Mickey Mouse Corporation of America. Doesn't matter. They don't care. It's a deemed disposition. So if you choose to not repatriate funds, that is a decision you've taken for yourself, right? I mean, nobody put a gun to your head to say, hey, you shouldn't repatriate. You decided it's in your best interest to not repatriate. So because you can't repatriate, you can't. It's a discretionary choice you've made, right? It's a choice you have made with your money. The CRA is not responsible for decisions you make with your money. They're just responsible for collecting the tax revenue.
Right.
Great.
Okay, well, that's really, thanks for.
It sucks, trust me, it sucks because it's a big advantage, but we don't have that.
A big advantage for US citizens for sure.
But hey, you move to the US, right? And you start filing taxes in the US, you won't have that problem.
Everybody's going to want to move to the US now.
Yeah, I mean, I've 1031 properties. I'm a Canadian citizen. I'm not a US citizen. I'm a US resident. Yeah. But I can, because I file my taxes in the US because I live here like, for the entire year. So I can 1031 all I like.
I love it.
Are you planning to become a U.S. citizen, or is that a strategy while you're?
I don't know. I don't know if it's a strategy. I might decide myself. My kids are U.S. citizens. In a few years, I might decide, but at this stage, it seems fine.
Got it.
Nice, nice.
Now, kind of just going through your storyline, so the background in finance, doing M&As, and then getting into real estate and more the multifamily space, just by somewhat of a coincidence, your family being involved. But we want to kind of discuss about your background in finance, and then that background assisting you in the real estate space, but not only the real estate space, but the real estate private equity space. There's the space that you're raising capital from investors. So Ava had a question here for you.
Yeah, I really wanted to talk about syndicated investments, and particularly, what we like to call real estate private equity. Yes. Was your background in finance, particularly with M&As, useful and helpful when you started in real estate private equity? Just let's touch on that. And I think August believes that M&As are the blueprint that real estate syndicators have used to acquire real estate. So.
Yeah, look, let's put it this way. It didn't hurt me. If that's what you mean. It didn't hurt me at all. Obviously, it provides more deeper perspective, greater insight, right? But let's put it this way. If I had started doing real estate in the US, say 10 years ago, right? Like I didn't do the 10, 11 years of working and I just did this from the start, I would be much, much more ahead. But for instance, because I had this background, I was able to quickly come up to speed. So it's just, if you just have a background in something and you can course correct and pivot and go to multiple areas, and you're able to quickly pick up on certain nuances and things. So it just helps you, right? So it didn't hurt me at all. Let's put it that way. But I also didn't live in the US. I didn't have all these opportunities. If I lived in the US, had all these opportunities, which I didn't have in Canada, maybe I would have started much earlier.
Right.
I mean, who knows, right?
Yeah, definitely. Okay. Now, I want to talk about my favorite topic, and that's raising capital. I love talking about raising capital. I know in the mergers and acquisition space, capital is mainly raised from institutional investors, right? So in our business, we're mainly focused on raising capital from retail investors. So could you talk to us about your background in the M&As and some of the same processes and techniques when raising capital from an institution? Could it be utilized when raising capital from retail investors?
I think potentially, but in my case, it didn't really help at all because when we were dealing with our counterparties, they were a lot more sophisticated. They had been around the block a lot of times. So, you could just hit the ground running with a lot of these folks, right? I mean, just because, they do a lot of deals like we did, right? So it's a very different conversation. doesn't mean it's good or bad. It's just a different perspective, right? Again, it's a bit like, I'll use the example. It's a bit like if two doctors meet, right? They might talk whatever language doctors used to talk with each other, I don't know, right? But they'll have a more like, say, technical discussion about, say, a case they saw or something they encountered versus, my wife's a doctor, but if she talks to me, she kind of has to explain it in different verbiage. She kind of 9 times out of 10, she's got to dumb it down, because she could tell me the scientific name of some disease as an example. I would have no idea what's going on. Right. So she kind of has to like explain it to me in layman's words. So she has like a lot of the building blocks that she would have with other doctors when she's explaining a case or has a situation, she doesn't have that with me. So the same way that, for instance, dealing with institutional people, it's a very different type of conversation, right? It's more transactional versus if you're, say, dealing with the retail investors, it's a lot more, you have to focus a lot on the softer side of your presentation as well. Right? Doesn't mean you don't have to. It doesn't mean you don't have to be softer on the institutional side, because relationships matter at every stage in life. But there, it's more. I mean, relationships are very important, but it's also very cut and dry, right? Whereas on the retail side, you have to do a lot of these confidence building events and like more active relationship management. And that's why some of the people who can do that, that's why a lot of finance guys, especially people like me, when we come and start talking to retail investors, we have much more difficulty in scaling up quicker than, say, people who are more heavily focused on the marketing angle of things, right? And are used to dealing with retail investors, they can scale up much quicker. Right. So in terms of capital raising, they might be able to scale up much quicker. So again, it's a different perspective, right? It doesn't mean one is right or wrong. It just means you're just dealing with your interaction is just very different. I don't know if there's like a better way of saying that. It's just more cut and dried on one side and more hooey and marketing and, we love you, you love me sort of deal on this side, right?
Got it. And just keep the conversation going about this idea. Just I want to kind of build a roadmap of your progress in your business. But so financial background, gets involved in real estate, multifamily, and stars align. Now you're involved in the space. At what point do you pivot to the need or the want to raise capital, to bring on investors, to bring on limited partners with yourself?
From day one, basically, man. Like there is not enough money in the world for me to buy a house, like just as an investment vehicle, right? I would much rather be poor than buy one house at a time, because that was not going to work for me. That was not going to solve my tax problem. And everybody says, oh, I cash flow $300. I was like, that's great. I can't even take my family out for a nice dinner for $300 in most major cities in the United States. Right. Look, if you take 5 people out to a steakhouse or to some upscale place, your bill is probably going to be more than $300. Okay, that's just going to happen, right? So cash flowing $300 wasn't going to solve my problem, right? My tax bill wasn't going to be an issue. So from day one, I had to do deals where I put a lot of our own money, but we frankly had a lot of investors from day one. So it just started day one. I mean, there was no buy a house, buy a duplex, because man, I would never get out of that crap ever.
Sounds good. And talk to us about that dynamic, that relationship between the GP and the LP, particularly in your case, when you're just starting out in this space. Yeah. How does that start? How do you build?
Well, you've got to beg a lot more people for a lot more money, man. And now I have to do slightly less begging. I still have to do begging, but I have to do slightly less begging. Or I have to beg more for more money. Yeah. But I have to beg less for less money.
Okay.
Got it.
Yeah, essentially, look, when you're starting out, obviously, either your network is smaller or there's more objections, which you think are objections, but maybe they're not really objections. Somebody more seasoned would just do it like that, right? But essentially, your network is smaller and you just haven't had that much face time with people like over years, right? So you just have to work harder to get the same amount of dollars, right? That's why people who've been around for a long time and are successful, by the way, they can pick up the phone and make 2 calls and they raise $50 million. And other people are struggling to raise 200 grand, right? So, and we're all begging, but at different levels.
Yes.
I have a question for you. When you first got into multifamily and you started calling people, did they have a difficult time understanding this syndicated investments?
No, because look, in my case, what had happened is now there is more difficulty because now my net is wider, right? But when I was starting out, I only had people in my immediate network of sorts, right? And people in my immediate network were really people in finance, right? Because it's like, doctors know doctors, engineers know engineers, business people know other business people. So if I'm in finance, my family's in finance, they'll probably know other financial people, right? I mean, accountants know accountants, right? So a lot of those people, yeah, I mean, you kind of have to explain a little bit, but they understand how things work, right? But again, that network also, you realize when you do more deals, at least my network is very limited, right? So now I have to increase my network over a period of time. And as I increase my network over a period of time, I'm now blessed to meet and interact with people from various backgrounds, right? Some people might have no idea about this. Some people have a little bit of idea. Some people maybe heard it, so they know it exists, but don't really know how it works, right? So now I have to do more explaining and more kind of walk people through, or rather I have a team also, right? So like kind of walk people through the various steps. Yeah. But initially I didn't have to walk people, but also initially I was raising less money. So.
Yep. And the reason Ava asks you about that kind of the knowledge, the knowledge that exists for investors looking to invest in real estate private equity or syndicated investments is initially when we started out, particularly for Canadian investors, we realized right away that this concept is very foreign to them. This idea of, hey, I can invest in real estate passively while someone manages the business and they just take a small portion and the majority of the profits comes to me. This idea was pretty foreign for Canadian investors particularly, and a lot of US investors as well. It was actually the reason for us starting this YouTube show was to educate and bring on experts like yourself so people kind of have a better understanding about this process.
Investing in real estate passively, most people think of being an active investor when they...
Yeah, I mean, look, that's a fair point, right? I mean, obviously I wasn't as smart as you guys, so I didn't have an entire plan made out. I had a problem, tax problem. I had to scramble to solve that tax problem. And luckily for me, I had some background, so that problem kind of got solved. Yeah. And then I had to put all the other pieces in place and then move forward accordingly. But again, if I was like, I'll be honest with you, if I was in Canada, none of this would have ever happened. None of this, not 5%, not 10%, 0% of this would have happened.
Right. Wow.
Okay.
It's just the odds are stacked against you. Look, it's just the way it is. Yeah. I was talking to a friend of mine. He lives in Calgary, working with me in the investment bank. He's moving back to Toronto, or at least I think he's moved back, or he's thinking about it, some version of that, right? And he's making about 250 grand, right? And he was moving back to Toronto, and I think they were going to pay him 300 grand or 350, but he just wanted to move away from Calgary. He just wanted to go back to Toronto. And him and I were talking, and I was like, look, bro, the point is, if you pay 50% in taxes, unless you make like $1 million a year, which not a lot of Canadians make $1 million a year, right? Look, even if you make 300 grand net in your pocket, you only have 150 grand coming into your pocket, right? I mean, 150 grand, look, 300 grand is like, if you tell people 300 grand salary, that's a nice salary. Don't get me wrong. That's a pretty nice salary in Canada. But if you start doing the math, if you live in Toronto, Vancouver, especially, right? If you get, say, 150 grand in your pocket, your rent or mortgage is minimum $3,000. I don't care what is happening.
Medium home price, 1.3 million.
Yeah, I mean, look,
90,000.
Yeah, I mean, think about it. And look, median is 90,000, right? So somebody who's making 300 grand is already like in the top 2 or 3% of people in Canada, right? And if they are going to struggle, look, if your rent or mortgage is at least 3,000, which is, it's way more than that. You and I know it, it's way more than that, right? So if it's 3,000, that's $36,000, right? If you got a kid, you send them to school, the kid is going to cost you 20 grand, okay? It's just the way things are. I got 2 kids, I know this, okay? So you're already at $56,000, right? Then you probably have car, gas, clothes, internet, right? Look, if you cut all your expenses, if you make 300,000, maybe if you're lucky, you've got 60,000 Canadian left. If you're lucky and you're really cheap and you get the cheapest place in Toronto or Vancouver, which cheap is still like $1 million point something. So it's not cheap in the grand scheme. Yeah. I mean, what are you going to do with 60 grand, man? No. Nothing. You can't, like, let's assume you save 60 grand, 30 years in a row, let's assume you go all the way up to 100 grand a year. 100 grand for 30 years in a row is like $3 million. Maybe you double that money. You got $6 million. Man, in 30 years, I bet you a house in Vancouver is probably going to be $10 million starting out. Easy. Mm-hmm. So your back is against the wall, man. You can't do anything. And this is for people who make 300 grand a year, which is crazy money if you think about
Crazy
it.
money, yeah.
That's
Yeah.
that's very important. This idea of investing, passively and making smart real estate investments. Smart investments not only in the conventional kind of the equities, but also in the private, in the alternative space. So that's why that's what we do. We bring this, but let's kind of move on to.
Yeah, I wanted to discuss
Sure.
this connection to Canada too. Are you currently servicing Canadian investors?
Yeah, I have lots of Canadian investors.
I
Lots
love
of
it.
people in my network.
Now, what percentage is, of the equities of your deals are coming from Canadians?
5 or 10% now. Most of this coming from the US now. There's just not enough Canadians.
5 or 10%?
Basically. Yeah, most. It started off as like 95% or something.
Yeah.
And it's gone to 5 or 10% now because frankly, number one, there's just a lot more money in the US. There's a lot more people in the US than I'm doing deals in the US. So obviously I'll know more US people. But also the thing is, frankly, if you get taxed at 50% plus, you need to have money before you can go invest somewhere. If you don't have money, you're getting taxed at 50% plus. How will you have money to give to someone?
You're getting taxed to death over here in Canada.
Yeah, you get taxed to death. I mean, how are you how you need to have money to give it to someone, right?
And yeah, funny enough, on our first deal that we closed at CPI, we had all Canadian investors.
100%
Yeah.
Canadian.
No, obviously you have Canadian investors because you live in Canada.
But
on
listen to this, Omar. But
Yeah,
go
on our
ahead. We
sec-
did zero advertising. We're known as the Canadian investors and people servicing Canadian investors who will invest in the US. We're based in Canada. But
and then on our second deal, we had our Canadian investors, and then US investors started contacting us, and more US investors started getting in touch with us.
Yeah.
And I was just wondering, in your experience, Omar, what has been the major difference between Canadian investors and US investors?
US investors are way more entrepreneurial and aggressive on average.
How about with their needs, investment thesis, and is it
If you're
similar
investing 50 grand, what investment thesis do you have? It's like go invest in multifamily. What thesis do you have? Really? If you want to have a thesis, you better have a couple of $1 million with you. If you got 25, 50 grand, people shouldn't take this the wrong way, but at 25, 50 grand, it's a lot of money, but it's not like you can go buy an office building with this thing and implement your thesis or something.
But Omar, so let's say someone who's got $1 million to invest, right? And let's say if they have an investment thesis on that $1 million, and if they follow the university endowment investment kind of process.
I don't think they can do it. I think they're actually stupid if they follow this is just my opinion personally, because I was in portfolio management.
Yes.
I personally think they're stupid to follow the university endowment model. And I'll tell you, you can see David Swenson's book, Pioneering Portfolio Management. I'll bring it up. Hold on.
No, sorry, what is it called? I'm writing this down right now.
This book,
let's see.
David Swenson basically wrote the Bible on basically the university endowment model. Okay. David Swenson, I think, was the head of Yale, right? And he basically wrote the model. He basically created the university endowment model. Okay. He's a legend. He just recently passed away. But you've got to realize these people have a lot more money. They can afford being illiquid. If you've even got $1 million, you shouldn't invest all your money in real estate. You should have a stocks exposure. I don't know why you'd have a bonds exposure. No idea. But you can't afford going years on end without getting any cash.
So let me ask you one more thing. A very important thing here, Omar, is so let's kind of do a quick case study here.
But you need to be somewhat diversified. So if you mean university endowment model is diversified,
Sure.
But you can't be 70% private equity. Because frankly, you have cash needs as human beings, and universities just have a way bigger, basically, base on which to work off of.
Got it. And so just quick, doing a case study on that person on that doctor, let's say, that makes $300K a year in Canada, ends up paying 50% of it in taxes, and tries to live off $175K a year. So he's got 70. It's netting.
I don't know how he's going to do that, but sure, we'll agree with you.
Let's just do a case study.
And
then on that 70, what would, in your opinion, what is the best diversification of that kind of it? What is the best plan for? How should they invest that? What portion of that should be? Or if let's say they've saved up $500,000 and they're still making $75K a year, how should they make that investment?
Look, it all depends on what their risk exposure is. As an example, like some people have a higher risk exposure and some people have a lower risk exposure. So you got to figure that out, right? Then you also have to figure out that everybody says, it's like that Mike Tyson saying, everybody's got a plan till they get punched in the face, right? So the problem is, a lot of people say, I want to take more risk because I want to make more money. Well, the problem with taking more risk is you can also lose more money. So if you have a really good plan and the first time you lose money, even though the plan is good, right? You just have to have patience sometimes, right? Things can go down and things will go back up, right? But as soon as you basically hit the first roadblock or something goes sideways and then you just completely give up your plan. And you're like, let's assume you're in real estate, you're like, oh, I'm never going to invest in real estate again. Or if you're in stock, I'm never going to look at stocks again. Well, then no plan is useful because you never really followed that plan to begin with, right? I mean, and the plan can't be a 6-month plan. It's got to be a 3, 4, 5, 7, 10-year plan, right? So understand your willingness and ability to take risks, then your actual ability to follow a plan or not. And you have to be self-aware. And then if you're a retail investor, frankly, your options are very limited. It's really real estate or the stock market. And in the stock market, I personally feel you should just shut up, go buy the S&P or TSX 60 index, right, from Vanguard. Don't buy it from one of the Canadian banks because they'll fee you to death. Okay, don't do that. Canadian banks have some of the worst mutual funds in the world. And this is not my opinion. There are actual studies to show we as Canadians pay the highest in fees for mutual funds. We pay the highest in fees for phone bills, for utilities across the board. So this is not my opinion.
Car insurance.
Yeah, car insurance. You know that. You're car insurance, man, bro. We get destroyed on car insurance, man, every month, right? So we pay such high fees that really just buy a cheap index, say an S&P 500 or a Vanguard, like TSX 60, whatever you want to buy, right? That's up to you what you want to buy, right? From a Vanguard or a BlackRock, buy the cheapest possible index, take, say, half of your money, put it into alts, let's assume a real estate or whatever you want to do. It could be real estate, it could be, angel investing venture, whatever you feel is interesting, right? Do that. And then just shut up and follow the plan. So the first time around, if something stupid happens, because look, you can invest in real estate and a crisis happens, right? And maybe it was bad timing, but it doesn't mean the asset class is just bad to begin with, right? So if you say in year one, unfortunately, a recession happens, you lose a bit of your money, or you didn't make enough money that you thought you were going to make, and then you swear off investing in real estate forever, as an example. Well, that's kind of stupid. Don't do that. Yeah. Right? So have, say, 50, 60% exposure in liquids, have, say, 50, it depends on your risk, have it in alts, and just shut up and follow a plan. Don't try to do anything too complicated. Don't try to act like a hedge fund guy when you're spending like 15 minutes a day watching, I don't know, CNBC or something, right? Don't do any of that stuff.
Okay,
great advice, Omar.
Great advice.
I want to know, where are you currently buying your assets? I know you're mainly focused in Texas.
Texas, Georgia, Florida, and I'm doing a development in South. I'm doing 2 developments, and a third is on the way in South Dakota.
These are ground up developments that you're doing?
Yeah.
Okay,
great.
Okay, very cool.
And now, maybe we can talk about Texas.
I really want to know the truth behind the insurance policies in Texas, because I know that there was some.
Oh, people are getting killed on insurance in Texas. Yeah.
Yes, let's talk about that, because I really want to.
Is it mainly hailstorms? That's.
It's just look. I don't know mainly what it is, because it depends where you are. But what's happened is supposedly a lot of 1 in 1,000 year, 1 in 5,000 year environmental events have happened, at least ever since I've been here, right? Like, we had a couple of hurricanes hit Houston, right? We had that whole freezing thing happen in Dallas and Oklahoma this year. And then every year something or the other happens, right? On top of the regular stuff of tornadoes and hail damages and soil movements and all of that stuff. So what's happened is a lot of insurers had taken a lot of losses on their books in the past years. Yeah. And now they have to make up for those losses somewhere. So a lot of insurers frankly went out of business. A lot of the smaller reinsurers or people who are insurance brokers, and they kind of work for other insurance companies, they frankly went out of business because they just couldn't take the amount of losses. So now a very small pool of insurers are left in Texas. Of those small pool of insurers, and it's really a handful. It's not even like 10. It's like 3 or 4 for bigger multifamily, right? Or 2, depending on the area. They know that if you don't go to them, you're going to go to their competitor. And their competitor kind of has similar pricing, because their competitor also faced the same losses that they faced in the last few years, right? It's not like their competitor didn't face losses, right? Maybe they had fared less or more, but they all faced losses. So you've only got 2 or 3 counterparties. They all know if you don't go to them, you'll go to their counterparty, and they're also going to charge you the same rate. So whatever, they're jacking up insurance by like double digits. And one of my partners, Sam, his property, what did he go up? He went up by 36% on his insurance.
So that's not affecting you. It's not affecting.
I'm not buying more assets in Texas. I did buy more assets in Georgia and Florida, but I have 2 assets in Texas.
Right.
Yeah.
Okay.
Got it.
Okay.
But Texas is still a great place. Look, insurance and all of that is there. But at the end of the day, if you can make enough money, then this is it's like any business, right? I mean, your costs will go up, your costs will go down. Maybe you make more money. So as long as you can make what you feel is an adequate return on your money. Like business hasn't stopped in Texas. Let's put it that way. There's lots of deals happening in Texas.
Yeah.
But it's a big problem. Returns in Texas, Texas has a huge problem that people who are not from Texas don't necessarily realize it. People who are in Texas have really reduced their spending. And it's not just in insurance, it's in taxes as well. Texas has some of the highest property taxes in the country. And those taxes are improved in some counties are increasing at a double-digit pace. So if your biggest line item is taxes and that increases at a double-digit pace, and frankly, you can't underwrite to those double-digit pace because then you'll never do a deal, right? Then you're going to get killed on taxes, killed on insurance, and killed on payroll. Payroll is a huge issue, not just in the US right now, but in Texas particularly, because there's frankly no unemployed people in Texas.
So today you wouldn't be looking at deals in Texas today?
I mean, I would look at them, but would I be as bullish as a deal in Georgia and Florida with my resources? No.
Got it. Got it.
But that doesn't mean deals in Texas are bad, because maybe somebody's doing more deals in Texas and they are more on the ground and have more knowledge, right? So it's not like one should just ignore it.
Yeah, of course. There's
But
always
I wouldn't do it.
diamonds
Is
in the
what I'm trying to say. Yeah, but I wouldn't do it, is what I'm saying.
Yeah,
I think
definitely.
Omar has been advising the passive investor this whole show, but we'll go ahead and get to this next question.
Yeah. We love to ask this question, Omar. And what is your advice to a busy professional looking to start investing passively in real estate?
Oh, just educate yourself a lot more. And look, a lot of times if you feel money's burning a hole in your pocket, it's probably not. Because just think about it this way. You probably, it took a little while for you to raise, to save 50,000, 75, 100 grand, 200 grand, right? So it's better that you wait a couple of months and invest with the right people or the right team, or whatever you feel is the right people, the right team, right? Then say you're in a hurry to invest in a deal and you see something hit at your inbox, email, and you get this FOMO. If I don't invest now, then whatever.
Don't let FOMO, fear of missing out catch up to you. Just
right? Because look, it takes so long to, like in the real world, it takes a long time to save $50,000, $100,000, right? So don't be in a hurry. Try to educate yourself, develop a relationship first, and then go from there. And initially that process seems very long because you're like, look, I got the money, I got to invest. But just take a step back.
Take a step back. Awesome.
Cool.
Okay,
so
ready?
Great. Awesome. We're getting to the next segment of our show here. I really appreciate the initial stuff. I personally got lots of golden nuggets away from that.
So great. Yeah, I know. He gave lots of golden nuggets.
Okay,
but
great.
I hope you're ready for the 10 championship round.
Sure, I hope so.
Financial freedom. I'm going to go ahead and start whatever comes top of mind, Omar. Who was the most influential person in your life?
Oh, there's many influential people. Like a lot of people will say parents. So obviously I'm very lucky that I had such responsible, highly ethical, moral parents. So that obviously helps, because if you have a good home environment, then, it really helps you as a kid growing up, right? Yeah. I'm very, very, very lucky that, and especially I'm at a stage in life where I see a lot of our friends getting divorced or separated or some version of that, because it's a stage in life, right? So I'm very lucky, so far at least, that I'm married to a very good woman. All the things that I had in my head in terms of what personality traits I wanted, what kind of accomplishments I wanted potentially in my wife and life partner. So far, it's good, right? I got two health. So these are people that are very influential in my day-to-day life, but I've also been very lucky to have really good teachers all along the way. And obviously I'm going to forget a lot of folks, but also a lot of mentors, not like paid mentors, but people who I worked with, who taught me stuff, who took the patience to actually, if I was doing something wrong, took the patience and time out to actually teach me. So obviously I'm going to forget a lot of people, but a lot of times a kind word said at the right time makes all the difference, right? Versus, I don't know, somebody showing you something super and grand, right? Somebody's kind to you, they're patient with you, they take the time, and they're there for you when you need them, even emotionally, right? Yeah. That in and of itself is so much more powerful than whatever some technical knowledge you could get from somewhere.
Absolutely.
Great advice.
Now, Omar, what is the number one book you'd recommend?
Oh, these days I just read this book and I bought it for all the guys in my EO network. Where is that book? Oh yeah, I have never bought a book just like I read it and then I bought a book just like that for people. But this is a book called Who Not How. Yes. Funnily enough, Dan Sullivan is a Canadian, right? So he's the head of strategic coach. I don't know if you know him. Yes. If you don't, you should please read everything he says. But wow, this is a great book. Again, nothing revolutionary in terms of if you were cynical, you read it and be like, oh, I don't really get anything. But it really, even though it's just been a couple of weeks, I can safely tell you this book really, everybody should go get it. I just bought 6 or 8 copies for all the guys in my EO forum. I'm going to give it to them. One of them I've already given them to.
That's awesome. I would have
Who,
said
not how.
I would have said that book too.
I got that book
Omar.
for my birthday, by the way.
Yeah.
Yeah, it's a really good book. If you haven't read it, I would highly suggest you read it.
Awesome. Now, Omar, if you had the opportunity to travel back in time, what advice would you give your younger self?
Oh, I would try to be born 10 years earlier and into a way richer family. If I could just do that, my life would be set, right? The second advice would be to move to the US much quicker.
Oh, wow.
Nice.
Okay.
I love that. I
Okay.
love that. I've been preaching that for a long time.
Yeah, you have.
And by the way, this is coming from somebody, I love Canada. Okay,
Yeah.
I love Canada. I think it's one of the nicest places in the world to raise your kids, raise a family, if you're extremely rich. Right? It's very peaceful. Look, in Canada, we don't have homicides happening. We don't have violent crime happening in that much, right? But man, it's really hard to become.
Yeah, I'll give you a stat.
Yeah.
Average number of murders in Canada per year, 500 approximately.
Yeah.
In the state of California alone, there's 14,000.
Yo, I think in Atlanta, they might have 500 every quarter, man.
Wow. So
Yeah.
sad.
All right.
Oh my goodness. Okay, Omar, what's the best investment you've ever made?
Oh, the best investment definitely was my education, like formal education, like going to college, going to a good college, being in an environment where, you know, I was surrounded by people much, much, much smarter than me, and just going through that whole college experience. I loved it. I think it's the best investment I could have ever made.
Fantastic. Now, what's the worst investment you've ever made?
Oh, a worst investment is, worst, it's not necessarily, well, there's lots of worst investments, but it's not necessarily investment. It's the things I didn't do, as an example. Like I didn't hire the right people at the right time. So it's not like an investment I make, but an investment I didn't make that I should have made.
Okay.
I didn't develop, say, I kind of spent a good portion of my 20s either working or partying, right? So I had a good job, but I was partying a lot. I had a great time. I wouldn't obviously trade that time because you need to get it out of your system. But now looking back, I could be like, look, I could have done so much more, right? So it's not necessarily the investments I made, but the things I didn't do.
Okay. First time anybody's ever said that. That's really cool. Yeah. How much would you need in the bank to retire today?
I don't think, first of all, it'd be like some weird amount, but I also don't think I could retire. I need to do something. Obviously I need to also maintain a good enough quality of life, not just for myself, but for my family as well, my kids especially. So, but even if I had that, I wouldn't retire because all the successful people I know of, and I'm very privileged to know a few, none of them has retired.
So just give us a number of what number would it be for you to not take?
Like in cash or in assets?
In cash, in cash assets, you can even.
No, they're way different, man. Cash is cash.
Some guests do monthly passive income. So just give us that number.
Oh no, bro. I mean, I don't know. I need to have I'm probably never going to get there, but I need to have like $300-400 million for me to be like, okay, I don't have FOMO. I can do stupid shit and it's not going to affect me. Right. That's what I think about money. Can I afford doing stupid stuff? And it does not affect me financially at all. And frankly, even if you have, in my opinion, even $30 or $50 million, I don't have it, by the way. Lots of money. It's a lot of money, $30-50 million, but you can't do stupid stuff and get away with it. Even at 50 million, you don't have you can't just do stupid shit and just be like, all right, here you go, here's the money, I'm done. I don't really care.
Yeah, exactly. These days it costs a lot just to go out and drink and eat. So you can.
Yeah, I don't know how much you're drinking, but yeah. So I don't have that much money, but yeah, I think 500 million should solve a lot of problems very quickly.
Yeah, I would say so.
But okay. Cash. Cold hard cash.
Cash is king.
Sounds good.
If you could have dinner with someone dead or alive, who would it be?
Yeah. Oh, that's a good question. I don't know. I have to think about it and get back to you because there's so many interesting people. So what I would also like to do is first think about it. And then I would also like to think, hey, before I got to that dinner, what steps would I have to take to make that dinner actually productive and useful for me, right?
Yeah.
Because
would it be like a politician, an athlete, someone in finance, someone that...
Oh, probably a politician or a world leader.
Okay, cool.
Nice.
Cool.
Nice.
Like a real OG, like somebody who's really done shit.
Yeah, for sure.
I love it. If you weren't doing what you're doing today, what do you think you'd be doing now?
Look, I was at a stage in life where I was going to do some form of a business or some entrepreneurial activity, right? When I started actually doing my own thing. So if I wasn't in real estate, I would like to think that even if I didn't have my own business, I'd be on the path to having my business in some shape or capacity. Because very early on, I realized, and I saw this with my parents, I was lucky enough to see it, that there were people who had a lot more money, but a lot of people didn't have time freedom, right? So we had enough assets that even when the business was down, we had enough assets that paid for our lifestyle and everything. So we didn't like essentially have to make money every month, right, to kind of make our paychecks, right? But my parents, because of having assets, and luckily that wasn't just us, it was because, you know, we inherited assets and all of that stuff, right? Had time freedom. So they had the time to adequately engage in their kids' life. They had time to actually go to all the funerals, the weddings, the birthday parties, right? Which a lot of really highly successful people, but who are working jobs like lawyers, doctors, whatever, you know, the highly compensated people, they don't have time these days.
Yeah.
Right. So for me, time freedom was very important. And I would be going in some direction where I had time freedom of sorts.
Okay, a couple more questions here.
Yeah.
Book smarts or street smarts?
Street smarts. I'm not street smart. I'm more book smart, but street smarts for sure. Street smarts win 99% of the time, straight up. And I have to learn this now, basically, when I'm doing my own business.
Okay. Last question, Omar. If you had $1 million cash and you had to make one investment today, what would it be?
Oh, I just buy the S&P 500 index and just go to sleep.
All right. All right. The real estate guy telling us to buy stocks. Come on, that's sacrilege.
No, but it's also, look, $1 million isn't crazy money if you think about it. I mean, you can't even buy a house in Vancouver for $1 million.
No, you can't.
You couldn't.
Yeah, there you go. Million sounds like a lot, but it's not crazy money. I mean, you can't even buy a house in Vancouver for that money.
Yes, true.
There we go.
True.
Awesome.
Or if you bought a house, you wouldn't be able to afford the taxes because you run out of cash.
There you go.
That's right. Okay,
Omar,
great.
what's the best way that people can reach you?
Well, they can email me, Omar, O-M-A-R, at boardwalkwealth, B-O-A-R-D, walkwealth.com. You can also go to our web homepage, boardwalkwealth.com. Right on the front page, you have an email opt-in which says name, email, and how you found out about us. Click on that. You'll get an email, verify yourself. You'll be added to our distribution list, and then you can hear my words of wisdom.
I believe I'm part of that list. Hey, thank you so much.
Yeah, me too.
Thank you so much, Omar, for your time. Really appreciate it in your busy schedule for you to come and give your time again, just in the pursuit of adding value to everyone. I really enjoyed this interview.
Me too.
And thank you.
Thank you so much.
Thank you so much. I'm very appreciative of your time. Thank you so much.